We are about to witness an interesting situation. The Fed has never before in its history been demanded $18 trillion, even though their balance sheet is half that size. Whether or not the Fed is ready to launch a hyperinflationary dollar regime, we will soon find out. Let's discuss it. We have already raised the topic of what decision the Fed will make at the March 22nd meeting, and I tend to support the same scenario so far. But today we will break down all possible options and how they will affect the price of Bitcoin, focusing on recent major developments. To start with the fact that the Fed decided to surprise everyone on Sunday, March 19th, released a major announcement that they have agreed with the European Central Bank, and also with the central banks of Canada, Japan, Switzerland, and Britain on cooperation. The essence of this association is providing dollar liquidity to banks in case of need. That is, if banks in Europe or Japan can't return dollars to their depositors, the FRS will print them for other central banks. That is, and will pass them further down the chain. That is, the banking crisis risks bringing the FRS printing press to the international level. By the way, logically, this agreement should imply a similar printing of the euro, pound, or yen, so that exchange rates will remain at a comparable level. But who knows how it will be in reality, while this news is perceived by the market as a trend for further weakening of the dollar. Another important episode which is worth highlighting before moving on. This is how the situation with the bankruptcy of the top two banks in Switzerland, Credit Suisse bank UBS, which at least feels good and is considered the top one in Switzerland, agreed to buy Credit Suisse along with all its problems, for $3.25 billion. Interestingly, at the time the deal was announced, Credit Suisse was valued at $7 billion, which means that UBS negotiated a 50% discount. But immediately after the news broke, the market corrected the injustice by dropping Credit Suisse shares by 60% in one day. I would also like to remind you that Credit Suisse has already received $54 billion from the Swiss National Bank to solve its financial problems. But as we know under the terms of the takeover, UBS will also receive additional financing from the Swiss National Bank in the amount of $100 billion. That is, the real problems of Credit Suisse are 3 times greater than they told about them after the first collapse of shares. As you see, banks really want money, and the more the better. American bankers have already asked the Treasury Department to lift restrictions on deposit guarantees. They are doing this because the Fed and Biden have promised to protect all depositors, to return their funds to them 100%. But as they say, there is a nuance. The Fed has already printed $300 billion to guarantee all deposits at all the necessary amount of almost $18 trillion. Of course, you and I have already seen in 2020 and 2021 years how the Fed's balance sheet doubled from $4 to almost $9 trillion in a short period of time. Can they repeat this trick in theory? Yes, and in practice, for the previous rampage of the printing press, we have already paid with inflation dollars of 9%. And if they turn it back on full power now, it turns out that Michael Burry was right, and we are in for a second round of inflation, which according to the most conservative estimate, will reach 20%. I can't know exactly when you turned this clip on, but I'm sure that right after the Fed's rate decision tomorrow, I'll release this information in our Telegram channel and follow the market's behavior and the Fed's comments online. Anyway, I'm waiting for everyone to Telegram. Sign up at the link right below the video. And so, let's discover a tool for predicting the Fed's supply decision, which is almost never wrong. 80% expect a 25-point increase. And that's the option we discussed last time, which I still think is a priority. The reasons for it are still the same. The Fed cannot abandon Jerome Powell's previous statements about the need to continue to fight inflation, especially when the statistics show the possibility of it returning to growth. That's why the Fed will give the bank money with one hand and raise the rate with the other, similar to what the European Central Bank did last week, just to show they are in full control and thus calm investors down. As it is the most expected outcome, it may lead to short-term volatility in the market, especially if no urgent media statements will be made after the Fed meeting. As a whole, markets will remain at their current indicators and will look for the new reason for formation of local trend. The second option, which has a probability of about 20%, involves stopping rate hikes here and now, and those who are more worried about the banking crisis than about inflation believe that the Fed can no longer raise rates unless it wants to lead the economy into even more trouble. It is important to understand that the term loans that the Fed is giving to banks now are at high interest rates at a high rate, and as a consequence will become even more expensive if it continues to be raised, and liquidity will have to be added. So Jerome Powell has a lot to think about because the decision to stop the rate hike could cause panic, as we said before. And with the fact that they are already formally back to printing money, such an action could drastically increase expectations for higher inflation, which in the short term is also a negative factor for markets, primarily for stocks. Now let's break down two options that are not in the expectations, but they are theoretically possible. The first one is a 50-point rate hike at once. It was relevant before the release of inflation data for February. The reasons for such decision may be only very bad statistics on inflation, which is already on the Fed's desk, but so far has not been made public. And if something like that happens, it means that the Fed has made a decision and is no longer going to sit on two chairs, that is, restrain inflation and save the banks at the same time. This will be a signal that the choice has been made in favor of inflation, while the banks will continue to fall, and investors will pay for it. As a result, a big negative for the stock market, which in case of a strong sell-off can spill over to Bitcoin and cryptocurrencies. And the second option from the most unexpected. This is a rate cut. You can see on this chart how the Fed has always responded by lowering rates in recent crises since the 2000s. By making this decision, the Fed is effectively admitting that the situation is close to disaster. The crisis has started, save yourselves, and so on. Such an outcome would be very negative for the stock market. But gold and Bitcoin, on the contrary, will have an interesting chance. Further, I will tell about what we are talking about, but at first I would like to ask you to support this video by subscribing who hasn't done it yet, and likes are also accepted. Now there is an interesting picture in the markets. On the one hand, the price of S&P 500 and Bitcoin continues to strongly correlate with each other, but on the other hand, the index of fear and greed and on the stock market shows a high level of fear. While a similar index for cryptocurrencies indicates high greed, this divergence in market assessment is related to the fact that the crypto community now has a very high hope that it is time for Bitcoin to break its correlation with the stock market and act as a defensive asset. And if the Fed starts lowering rates and goes back to the printing press, then stocks could go to one thing while an early bull market starts for Bitcoin. I'm not giving financial advice, just sharing my thoughts on the current situation. It used to be that the dollar was always the winner during a crisis, but stocks, gold, and Bitcoin used to go down hard in a moment and then come back up, aided by the Fed's printing press. But this hour, because of high current inflation, many are looking at hyperinflation of the dollar, which will not allow it to grow on the crisis, and as a result, the money could go into gold and Bitcoins. My opinion is that this scenario has little chance of materializing, but who knows what will happen next. So it is necessary to keep a close eye on everything and to inform you through a channel in Telegram. Thanks for watching your cryptocurrency.